Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, we're in the thick of earnings season, and we don't want to bore people with a lot of stats, but I'm going to use the word but. We are seeing some amazing numbers come out from these companies that we want to share with people. As of Monday, 177 S&P 500 companies have reported earnings, and there are 151 more reporting this week.
Big week. Yep.
It's a huge week. And so Facebook reported the revenue being up 56% over a year ago. Apple, one of the largest companies in the world, their revenue was up 36% over a year ago. Pretty staggering numbers.
Yeah, that's amazing growth. And earnings, Steve, are the primary driver of stock returns over time. So we like to dig into these numbers a little bit and geek out on it. The S&P 500's profits are on track to be up 90% over the past year. Remember, that growth is starting from a very low base. I mean, think about where we were in the second quarter of 2020. We were in the thick of the pandemic. The economy was, partially shut down, and companies weren't exactly printing money. Wall Street, going into this earnings season, was actually projecting earnings growth of only 65%. And I say only 65%. But this is just another example of how unreliable projections can be during unstable times. I like earnings season, particularly in this unstable environment, because the markets get a bit choppy, and it gives us an opportunity to pick up companies we like at better prices.
Yeah, Travis, that's right. And speaking of unreliable projections, so far 89% of the reports have beaten the street. And that is the highest beat rate in 25 years that they've been tracking it.
Yeah.
The normal beat rate is 60 to 65%.
Yeah, and Steve, those earnings beats you're talking about are coming in 17% above Wall Street estimates. I don't want to beat a dead horse, but remember what we said about Wall Street projections. Normally, when a company beats earnings, or the normal beat rate is just about 4% above estimates. So if you view returns on stocks as a combination of earnings growth, dividend yield, and multiple expansion, 2020's returns, or the returns we got last year, were driven by multiple expansion or investor optimism about the future. 2021 is shaping up to be a year of earnings growth, just given the numbers we're talking about. So we'll continue to see if companies can live up to the expectations throughout the rest of the year.
That's right, Travis. This has been great. I look forward to it next week.
I look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.